All right, let's unpack this. We need to start with the just astronomical numbers behind this whole AI build out. The financial headlines lately, I mean, they haven't just been big. They've been almost impossible to really wrap your head around. We're not talking billions anymore, not really. We're talking about commitments that, well, they hit the $1 trillion mark.
That's right, a trillion. And we're focusing specifically on OpenAI here. A company, recently valued somewhere around $500 billion.
Which is already huge.
Exactly. But then they've committed to this stack of overlapping multi-year infrastructure deals. We're talking giants like NVIDIA, AMD, Broadcom,
All of
Oracle.
those names in the space.
Pretty much. And when you add up the projected cost, for access and deployment across all these deals, the industry consensus, it really puts the total commitment at nearly $1 trillion just for AI infrastructure build-out.
That's just a staggering figure, especially when you look at their actual operational financials. We've sifted through a ton of material for this deep dive, financial news reports, company transcripts, analyst critiques. And the mission for us today really is to grapple with this core paradox. It's right at the heart of the story. How does a company projecting, maybe $12 billion to $15 billion in annual revenue this year, how do they commit to nearly $1 trillion in future spending?
It's probably the highest stakes gamble in modern corporate history. I mean, it's not just a tech race anymore.
Yeah.
It's a financial bet, an industrial bet. Really, it's a bet on the future value of knowledge work itself. And it needs a level of infrastructure commitment you'd normally only see from, like, nation states or maybe global utility providers.
Absolutely. So let's dive right in. Part one, the $1 trillion commitment. We need to understand the scale of compute involved and this really unusual financing paradox that seems to be making it all possible.
Okay, so we have to start by establishing the scale, right? Because $1 trillion, it's just abstract. But this estimate, it's not just pulled out of thin air. It seems to be coming from internal OpenAI executive projections, basically what they think it'll cost to secure the compute they need.
Right. And the key metric here isn't really dollars directly. It's about power capacity. We measure it in gigawatts or GW.
Gigawatts, okay.
Yeah, that's kind of how the infrastructure market prices this stuff out. The consensus estimate, and this is based on, current chip costs, cooling costs, everything. It suggests that deploying just 1 gigawatt of operational AI computing capacity costs about $50 billion.
$50 billion for 1 gigawatt.
Yep, that's sort of the foundational number for this whole discussion. Keep that $50 billion per GW in mind.
Okay, $50 billion. That sounds massive already, but the numbers for OpenAI's deals, they're even bigger than that. Oh, much bigger. If you tally up all the recent contracts we know about the NVIDIA partnership, that huge AMD order, the custom Broadcom project, the Oracle Cloud deal, you put them all together.
Yeah.
They collectively grant OpenAI access to more than 20 gigawatts of total computing capacity. Now, that's spread out over the next decade or so, but still, 20 gigawatts.
Wow. So if we take that $50 billion per gigawatt metric and apply it to the 20-plus gigawatts they've secured access to.
You land right in the neighborhood of that $1 trillion total infrastructure commitment.
Yeah.
Okay.
So the math checks out in a terrifying sort of way.
Right. And to really ground that number for you, for the listener, 20 gigawatts, that's roughly equivalent to the power output of about 20 modern nuclear reactors.
20 nuclear reactors just to run AI models.
We're basically talking about acquiring the industrial power grid of a small country. That's the scale of energy needed here.
And it's crucial to understand this isn't just like buying software licenses. This is an infrastructure purchase. It's a commitment to massive capital expenditure, CapEx, over many years.
That is a key differentiator.
Yes.
Capital expenditure. They're committing to buying physical assets that depreciate chips, servers, data centers, power infrastructure. It's very different from OpEx, operational expenditure, which is, paying salaries or cloud subscription fees.
So they're committing to $1 trillion in CapEx.
$1 trillion in CapEx, essentially, without actually having the cash on hand to pay for it. Hashtag 1.2, the $1 trillion paradox, and cash burn.
And that brings us right back to the paradox we need to unpack. How does a company with maybe $15 billion in revenue this year even begin to handle a $1 trillion commitment? I mean, they aren't just spending money, are they? The report suggests they're burning through it at a historic rate.
Oh, the cash burn is brutal. Absolutely brutal. The sources we looked at show OpenAI is projected to burn through, get this, $115 billion by 2029.
$115 billion.
Yeah. And that's just to cover R&D, operations, and maybe the initial down payments on some of this infrastructure.
Right.
If that projection holds, I mean, it basically solidifies OpenAI as one of the largest planned cash-burning enterprises in, well, modern corporate history.
Okay, let's break down that burn rate against their revenue. You said revenue for the first half of 2025 is projected around $4.3 billion.
That's the number, yeah. Sounds okay on its own.
But
But in that same period, they were apparently slated to post an operating loss of $2.5 billion.
ouch.
And that loss is driven heavily by R&D and specifically the cost of training these next-generation foundational models. That bill hit $6.7 billion. The cost to train is just outpacing the money they're making from selling the services right now.
Which creates a huge funding gap.
A massive gap.
Yeah.
And it means they need cash, like now, just to keep the lights on and maintain their projected operational runway to 2029. And let's forget the trillion-dollar capex for a second just for operations.
Yeah.
They probably need to raise an additional $50 billion to $75 billion.
Either.
Through more private funding rounds or potentially an absolutely colossal IPO.
Which explains why the structure of these infrastructure deals is so, well, unusual and maybe risky.
Exactly. This huge financing hole seems to have forced them into using what analysts are starting to call circular financing, or sometimes round tripping.
Okay, circular financing. That phrase alone should raise some eyebrows for anyone who remembers the dot-com bust.
It definitely should.
It immediately makes you think of the TMT boom, technology, media, telecom back in the late 90s, early 2000s, where vendor financing was everywhere. Can you kind of unpack the mechanics? How does circular financing work in this AI context today?
Sure. It seems to be a mechanism born out of sheer necessity. You have a cash-rich supplier, let's say NVIDIA, right? They have massive free cash flow right now.
Right.
They commit a huge amount of capital, maybe $100 billion, let's say. It could be a direct equity investment in OpenAI, or it could be structured as like a prepaid capacity contract, basically a big down payment for future chips.
Okay, so NVIDIA puts $100 billion into OpenAI.
Right. And then OpenAI almost immediately uses that investment capital to purchase chips or systems or cloud services back from that same supplier, NVIDIA in this case, or maybe a strategic partner of NVIDIA's.
So the money leaves NVIDIA's bank account, shows up on OpenAI's balance sheet as an investment, and then it flies straight back to NVIDIA as revenue for chips they just sold.
That's the essence of it, exactly. And analysts, folks at Goldman Sachs, RBC, they've voiced pretty extreme caution about this.
I bet.
They point out that this dual role, being both the investor and the supplier, means the whole deal structure needs really intense scrutiny. In a normal business transaction, right, you've got an independent buyer who's validating the demand for the product.
Sure.
But here, the vendor is effectively financing the purchase of its own products, which kind of masks whether the underlying demand is truly there or if it's just the financing itself creating the sale.
Okay, that's why the TMT parallel feels so spot on. I remember Cisco and Lucent back in 2000. They sold enormous amounts of networking gear by offering vendor financing to customers like Global Crossing or WorldCom.
Exactly. Those companies built these huge fiber optic networks.
Networks that, it turned out, almost nobody ended up needing at that scale back then.
Right. And when those customers couldn't generate the revenue to pay back the loans from Cisco or Lucent, they defaulted, and they dragged the vendors down with them.
So the core question today is the ultimate demand for AI, things like agentic commerce, enterprise AI tools, is it real enough and will it scale fast enough to justify this massive infrastructure build-out that's being financed in part by the builders themselves?
That is fundamentally the entire trillion-dollar risk calculation in a nutshell. But OpenAI, they aren't just sitting back. They're aggressively pursuing this massive three-way chip race strategy. They want to secure the compute power they need, but also, critically, reduce their reliance on any single vendor. They don't want to get squeezed later on pricing or availability. Hashtag tag 1.3, the three-way chip race strategy.
Right. The strategy feels like it's about control, doesn't it? It's not just raw speed. It seems like they want to own the underlying design or at least have more influence over it. I remember that statement from co-founder Greg Brockman. It felt like a huge strategic signal. He said something like, by building our own chip, we can embed what we've learned directly into the hardware, unlocking new levels of capability. They want custom silicon.
Exactly. And the deals they've struck seem designed to acquire both kinds of capacities simultaneously, the best off-the-shelf stuff and custom-designed chips. So first, you absolutely have to acknowledge NVIDIA. They're the anchor deal here. They are the established standard in AI hardware right now.
They're definitely the biggest piece of this puzzle, yeah.
NVIDIA is providing this massive investment and partnership framework. Rumors put it potentially over $100 billion, covering systems and access. The goal seems to be ensuring the deployment of at least 10 GWI of NVIDIA-based capacity.
And NVIDIA's strength isn't just the chip itself, right? It's the whole package.
Precisely. It's their entire ecosystem. The integrated systems they sell, the networking solutions like InfiniBand, and maybe most importantly, their CUDA software stack.
Ah, CUDA, the software lock-in.
That CUDA lock-in is huge. It makes moving to any competitor incredibly expensive and complex from a software perspective.
Yeah.
It really forces everyone else to play catch-up.
But others are trying to catch up, and they seem to be making headway, partly because the demand from OpenAI and others is just so immense. So the second pillar of the strategy is AMD. Their push seems really aggressive.
Very aggressive. Their deal secures OpenAI access to multiple generations of AMD's flagship Instinct GPUs. The plan is for these chips to power around 6 GW of AI infrastructure. Deployment is slated to start in the second half of 2026.
6 gigawatts, that's still a huge chunk.
It is, and the AMD deal is particularly fascinating because of the financial mechanism tied into it. It involves warrants.
Warrants, okay, explain those.
So AMD issued warrants to OpenAI. For listeners, a warrant is basically like a stock option. It gives OpenAI the right to buy AMD shares later at a specific predetermined price. This specific deal allows OpenAI to potentially receive up to 160 million shares of AMD. That's roughly 10% of the company.
10%.
Yeah, if AMD hits certain operational targets like delivering the chips on time and with the promised performance, and crucially, if AMD's stock price hits certain targets over time as well.
Okay, so that's a really strong incentive alignment, isn't it? OpenAI isn't just a customer anymore. They literally have a vested financial interest in AMD's success.
Exactly. If AMD delivers and their stock goes up, OpenAI gets this massive potential equity payday. If AMD fails to deliver the capacity or performance they promised, OpenAI gets less value from the warrants. It's a clever strategic lock-in device. It's designed to make absolutely sure AMD delivers the goods.
Right. Makes sense.
And the revenue for AMD is very real. Their CFO, John Hu, noted this commitment is expected to deliver tens of billions of dollars in revenue for AMD. It immediately validates them as a major player, a platform capable of monetizing this AI revolution at serious scale.
Okay, so NVIDIA is the foundation, AMD is the challenger providing diversification. What's the third pillar? This is where the custom silicon comes in.
This is where Broadcom comes in. This collaboration seems specifically designed to fulfill that Broadcom vision of custom OpenAI-designed hardware. The partnership is focused on developing and deploying 10 GW worth of custom OpenAI-designed AI accelerators. These are ASICs, application-specific integrated circuits, and also highly specialized network systems to connect them all.
Another 10 gigawatts. So that's 10 from NVIDIA, 6 from AMD, 10 from Broadcom. We're already past 20 GW just with these three.
We are. This Broadcom deal represents a massive multi-billion-dollar commitment to these custom ASICs that OpenAI is designing themselves. Deployment for these is also scheduled to start in the second half of 2026, with full completion planned by the end of 2029.
Okay, now there was some confusion around Broadcom, wasn't there? About a mystery $10 billion customer.
Yeah, there was. We should clarify that. Broadcom's president did confirm that OpenAI is not that specific mystery $10 billion customer. But the fact that Broadcom apparently has multiple customers placing separate multi-billion dollars and even $10 billion orders simultaneously, well, it just underscores the absolutely unprecedented level of demand for custom AI silicon right now. It's not just OpenAI.
Right. So, okay, OpenAI has lined up the chips. NVIDIA for the stable, standard foundation, AMD for diversification and as a performance challenger, and Broadcom for the custom-designed advantage. But like you said, you can't just run 20 gigawatts worth of chips in a cardboard box. You need somewhere to put them. Which brings us to the cloud, the data centers, and the strategic partners in the initiative codenamed Stargate. All right, so the chips need homes. Massive data centers. And these data centers, they need cloud infrastructure providers to run them. This huge compute expansion effort seems directly tied to this project, Stargate. And the massive cloud partners stepping up here seems to be Oracle.
Oracle Cloud Infrastructure, yeah, OCI. They are taking a really huge swing with this. It's reportedly a 5-year cloud computing agreement, estimated value around $300 billion.
$300 billion, just with Oracle.
That's the reported number. It's set to begin in 2027. And this contract alone requires Oracle to deploy about 4.5 GW of capacity for OpenAI. To do that, Oracle will have to build and operate these enormous new data centers, likely in places like Texas and New Mexico, where you can get access to relatively cheaper power and land.
Okay, $300 billion is obviously a massive potential revenue stream for Oracle, but it must also put immense pressure on their own finances, right? Oracle is committing to build tens of billions of dollars worth of assets here.
Absolutely. We have to consider Oracle's existing financial situation. They already carry very large debts from previous acquisitions and activities.
Hmm.
They actually just recently issued another huge debt package to finance other things. So this raises critical questions for analysts watching Oracle.
Hmm.
Can they actually internally finance this massive infrastructure build-out that the OpenAI contract requires? Can they do it without seeking external capital?
Or will they be forced into what you mentioned earlier, a dilutive equity issue?
Exactly. Let's pause on that again because dilutive equity issue is important financial jargon.
Yeah, let's break it down.
Okay, so in simple terms, if Oracle did a dilutive equity issue, it means they would sell brand new shares of Oracle stock to the public market to raise cash. They'd use that cash to build the data centers for OpenAI.
Okay, sounds like a way to get the money. What's the downside?
The downside is that it dilutes the ownership percentage of everyone who already owns Oracle shares. You're adding more shares to the pool, so each existing share represents a slightly smaller piece of the company. This often causes the stock price to drop, at least temporarily. And Oracle's leadership historically really hates doing things that hurt their stock price. So this huge OpenAI commitment puts immense pressure on Oracle's financial engineering team. They need to figure out how to pay for all this without damaging their stock value.
Right. It's like high-stakes financial gymnastics playing out behind the scenes.
Yeah.
And we're already seeing ripple effects, aren't we? OpenAI's sheer demand seems to be forcing Oracle to rethink its own hardware strategy.
That's right. The enormous backlog for compute, largely driven by OpenAI's needs, seems to be pushing Oracle to diversify its chip supply chain beyond just NVIDIA. We saw that recent announcement. Oracle plans to deploy 50,000 of AMD's new MI450 chips in its data centers, starting in the second half of 2026.
50,000 AMD chips going into Oracle Cloud.
Yeah, and analysts are saying this is likely a direct consequence of the OpenAI deal. Demand is just so high that cloud providers like Oracle are becoming, quote, more comfortable using AMD as a source of AI chips. They simply need more suppliers to ensure they can meet these massive capacity requirements on time.
Okay, so Oracle is stepping up as a major Stargate partner, but we also have to talk about Microsoft's role here. They were the foundational partner, right? Microsoft committed over $20 billion since 2019, a lot of that in Azure cloud credits. For years, it felt like Microsoft had an almost exclusive arrangement with OpenAI.
They did have a very tight, almost exclusive relationship for a long time. But the sources we've reviewed indicate the relationship is evolving pretty dramatically, especially as OpenAI seeks broader validation for its valuation and needs more diverse funding sources.
How is it evolving?
Well, they've apparently been negotiating amendments to their original agreements. And this seems to have culminated recently in a non-binding Memorandum of Understanding, or MOU.
A non-binding MOU. Why is that significant? What does non-binding mean here?
Non-binding means it's not a final legally enforceable contract yet, but it signals the agreed-upon direction. And the significance lies in what that direction is. It appears to be a definitive step toward what's being called an investor-friendly, for-profit structure for OpenAI.
And what does that mean for Microsoft's access?
Historically, Microsoft had pretty much exclusive rights to deploy OpenAI's most advanced frontier models within its Azure cloud. This new dynamic suggested by the MOU seems to be shifting towards more of a rights of first refusal model.
Rights of first refusal, meaning?
Meaning OpenAI can now more freely seek diverse funding and deployment partners like Oracle, for instance. They just have to offer Microsoft the chance to match the deal first. If Microsoft declines, OpenAI can go elsewhere.
Ah, okay. So it allows OpenAI to maximize its valuation by essentially selling access to its models to the highest bidder globally. It reduces Microsoft's previous chokehold on their distribution.
Exactly. It opens the door for broader partnerships and, crucially, broader investment, which OpenAI desperately needs given the cash burn we discussed.
Okay, so the partnerships are shifting. The financing is creative, let's say. The infrastructure commitments are astronomical. But we have to keep asking the core question. Is this just building incredibly expensive infrastructure for its own sake? Or is there a clear pathway to generating the revenue needed to justify this trillion-dollar spend? We need to shift focus now from the raw compute power to the actual consumer application value. Let's look at a real-world use case that might hint at the answer: the Walmart partnership. This feels like where the rubber meets the road, right? Where we might see the actual engine of economic value that's supposed to pay for all those gigawatts of power. The Walmart partnership is maybe the clearest example yet of this concept being called agentic commerce.
Agentic commerce. Yeah, it's a key concept. It basically means the AI isn't just a search engine or an answer bot anymore. It becomes an agent that can take action on your behalf. It can navigate complex multi-step tasks for you.
And how does that work with Walmart?
So in the Walmart partnership, shoppers can use ChatGPT to look up products. I think it excludes fresh foods for now, but most other things. They can ask follow-up questions, maybe refine their search, personalize an order.
Okay.
And then this is the crucial part. They can simply click Buy directly within the chat interface for instant checkout using their linked Walmart account.
Ah, so it closes the loop. It's not just finding the product, it's buying it right there in the conversation.
Exactly. And this builds on similar partnerships OpenAI announced previously with platforms like Etsy and Shopify. It's effectively turning ChatGPT into a transactional agent. It can handle the entire shopping process from discovery to purchase.
The significance of that seems potentially massive.
Oh, it is. Think about the traditional e-commerce experience. It's pretty linear, right? You navigate pages, click categories, maybe filter results, manually add items to a cart, then go through checkout steps.
Right. Lots of clicks.
With agentic commerce, the AI handles the conversation and the transaction simultaneously. You just talk to it.
Yeah.
I need running shoes, size 10, good for trails, under $100. It finds options. You discuss, you pick one. Okay, buy those. Done.
That sounds much easier.
It's potentially a far more compelling user experience. And for businesses like Walmart, it represents a high-volume, real-world, revenue-generating use case for AI. If even, say, 10% of Walmart's massive online commerce volume eventually shifts to an agentic format like this.
The transaction volume flowing through OpenAI's interfaces would become enormous.
Exactly. It becomes a potentially huge income stream for OpenAI, likely through transaction fees or licensing deals.
And this presumably is the direct monetization pathway that OpenAI and its investors are betting on to eventually balance out those staggering infrastructure costs.
That has to be the hope. The bet is that the productivity gains, the convenience, the new capabilities unlocked by agentic commerce, and also similar agentic tools for enterprise use cases will be so profound, so valuable.
That the trillion-dollar infrastructure investment quickly becomes just, well, table stakes. The cost of doing business in this new AI-driven economy.
That's the bull case argument. Yeah, it's the ROI equation.
Yeah.
If these chips and data centers don't deliver immediate, massive productivity gains through tools like the Walmart integration, then yeah, the infrastructure spend starts to look badly misallocated. The core assumption underpinning everything is that the economic value created by this new layer of AI interaction will ultimately far exceed the cost of the compute needed to run it.
Okay, but even if the application side, like agentic commerce, is wildly successful, we keep bumping up against this ultimate immovable physical constraint. Energy. You can have the best AI models and the fastest chips, but they need electricity. Lots of it.
And here's where it gets really interesting, and maybe a little scary. The industry consensus on this seems unanimous now. Power availability isn't just an issue. It is rapidly becoming the single largest bottleneck for AI deployment globally.
The physical world is pushing back.
It's pushing back hard against the speed of silicon development. Moore's law might still be sort of chugging along for chips, but building power plants doesn't follow Moore's law.
Right. We established the capacity need earlier, potentially over 20 GW, just for OpenAI's immediate commitments through partners like NVIDIA, AMD, Broadcom, and Oracle. This level of consumption requires immense new power generation solutions that, frankly, mostly don't exist yet.
And to put this into the context of how long large-scale infrastructure actually takes to build, consider the Vogtle nuclear plant expansion down in Georgia.
Yeah.
It's one of the biggest new power generation facilities built in America in decades.
Yeah.
Final cost was around $36 billion, and it took over a decade to construct and bring fully online.
$36 billion in over 10 years for one plant.
Right. Now, OpenAI's combined needs, that 20-plus GW figure, is equivalent to needing the power output of about 2.5 brand-new Vogtle-sized nuclear power plants.
2.5 Vogtle plants?
And they need that power within the next, say, 5 to 7 years to meet the deployment timelines of these chip and data center deals, not 10 or 15 years from now.
That timeline seems challenging, to say the least.
It's incredibly challenging. And you see this reflected in how the utility companies are reacting. For decades, utilities relied on very stable, very slow growth projections for electricity demand, maybe 1% or 2% increase per year. They built their grids and planned their investments based on that.
And now AI data centers come along demanding exponential growth.
Exactly. They're simply overwhelmed by the sudden massive appetite of these facilities. The sources we looked at highlight the utility response, and honestly, it reveals their deep nervousness. They're worried about committing billions to build new infrastructure to serve these hyper-growth customers who might then potentially scale back plans or even go bust.
Leaving the utility holding the bag for assets nobody else needs.
Precisely. So utilities are now demanding massive upfront capital commitments from the data center builders or the AI companies themselves. We saw an example. Georgia Power is reportedly demanding $600 million upfront just to secure contracts for $500 million of power.
Wow, $600 million up front, just for the right to buy power later.
Essentially, yes. The customer, in this case potentially a data center, serving someone like OpenAI, has to help finance the utility's necessary grid, upgrades the new transmission lines, the substations.
So the utility is basically passing the capital cost, or at least the risk, of building that supporting infrastructure directly onto the AI customer.
That's what it looks like. They're saying, look, if you want us to build this stuff just for you, you need to pay for a chunk of it now, because we can't afford to get stuck with billions in stranded assets if your AI demand forecast turns out to be overly optimistic.
Makes sense from their perspective, I guess.
And it's not just upfront capital. Utilities like Alabama Power are also requiring really high minimum usage commitments, sometimes up to 90% minimum power usage guaranteed in the contract.
Why 90%?
It's another safeguard. It prevents customers from massively over-ordering capacity, maybe booking 1 GW just in case and then only using half of it. Yeah. That would also strand the utilities' generation assets they built or contracted for based on that 1 GW due promise.
Okay.
The underlying reality driving all this is the mismatch in timelines. The lead time for building a big new combined cycle gas plant is maybe 4 to 5 years minimum. A new nuclear facility, as we thought, is more like 10 plus years. But the lead time for designing and manufacturing a new generation of AI chips, maybe 18 months to 2 years.
The timelines just don't line up at all.
Not even close. So the AI race isn't just a chip race anymore. It's not even just a data center race. It is definitively, fundamentally an energy race now.
Whoever can solve the power generation puzzle and the transmission puzzle fastest, they are the ones who will ultimately win this infrastructure build-out.
Absolutely. And that hard energy constraint is starting to drive some really interesting new investment patterns. We're seeing a distinct and growing correlation between major AI development hubs and investments in nuclear energy.
Nuclear? Because it's high-density power.
High-density, reliable baseload power, and crucially, it's carbon-free. When you need 20-plus gigawatts delivered reliably 247 into a relatively contained geographic area to run these massive data center campuses, nuclear starts to look like one of the only technologically viable options that can scale that high, that quickly, without fossil fuels.
Interesting. This energy shortage also feels like it could have significant geopolitical implications, couldn't it?
Huge implications. Access to reliable, cheap, and abundant energy could become a major source of competitive advantage for nations in the global AI race. Countries that can streamline permitting and quickly mobilize resources to deploy new power generation, whether it's nuclear, geothermal, or massive renewables with storage, might gain a significant edge.
Posing a potential risk to the U.S.'s current leadership position in AI infrastructure if domestic energy solutions can't keep pace with the demand from companies like OpenAI.
It's definitely a risk factor that policymakers are starting to grapple with. You can have the best chip designers and the best AI researchers, but if you can't plug their machines into the wall, you fall behind.
Okay, so we've covered the scale, the financing, the partnerships, the applications, the energy crisis, which inevitably brings us to the ultimate question, the one that makes anyone who lived through the dot-com crash twitch a little bit. Are we currently in an AI bubble? What's remarkable is that we're not just hearing this concern from, skeptical analysts on the outside. We're hearing high-profile figures within the tech industry itself openly discuss it.
It is remarkable candor, actually. You've got Jeff Bezos talking about it, Mark Zuckerberg, the CEO of Goldman Sachs, David Solomon. Even OpenAI's own Sam Altman has publicly acknowledged the potential for a massive AI boom and bust cycle.
When the leaders themselves are openly using the B word, you know the stakes are incredibly high.
Absolutely. And the bears, the people warning about a bubble, they're sounding the alarm based heavily on two things: the sheer scale of capital required, which we've discussed, and the unusual financing structures like circular financing being used to fund it. Hashtag tag 3.1, the bubble bear case, and historical parallels.
Right. So the core warning seems to center on the risk of massive capital misallocation. The fear is that a huge chunk of this trillion-dollar commitment, maybe the vast majority of it, simply won't deliver the financial returns needed to justify the current valuations and the spending levels.
Exactly. Let's try to get a bit more granular on those required returns. One venture capital partner, David Can, put out an estimate.
Yeah.
He figured that just the AI infrastructure built in 2023 and 2024 alone
Yeah.
requires the end users of that infrastructure to ultimately purchase roughly $800 billion worth of AI products and services over the useful lifespan of those chips and servers, just to generate a reasonably healthy investment return on that initial build-out.
$800 billion in product sales needed just to break even on the first couple of years of investment.
Essentially, yes, to make it a good investment. And if you look further out, consultants at Bain & Company estimated that by the year 2030, this ongoing wave of AI infrastructure spending will necessitate something like $2 trillion in annual AI-related revenue across the entire ecosystem just to sustain itself.
$2 trillion annually by 2030.
Compared to, what was the estimate for AI product revenue just last year? Maybe $45 billion?
$45 billion last year.
Yeah.
Needing to get to $2 trillion annually in about 6 years.
That's roughly a 44x increase in the annual revenue requirement in just 6 years. It's an absolutely enormous leap. If those agentic commerce use cases, the enterprise AI tools, if they don't materialize and scale incredibly fast, the whole edifice starts to look very shaky.
And that brings us right back to the historical warning, doesn't it? The reliance on circular financing, the vendor funding, where suppliers are essentially bankrolling their customers' massive CapEx purchases. It just draws these direct, uncomfortable comparisons to the TMT collapse in 2000.
It really does. Companies like Global Crossing, WorldCom, they built enormous infrastructure based largely on debt provided by the equipment vendors themselves. And that infrastructure ultimately failed because the underlying revenue projections never, ever showed up at the scale they promised.
To really hammer home the scale difference, that same analyst, David Kahn, estimated that the current AI infrastructure investment cycle could potentially be 17 times larger than the dot-com bubble once you adjust for inflation and the sheer scale of the capital expenditure being committed today.
17 times larger. That level of potential overinvestment, fueled by this kind of financing, is what terrifies classic financial analysts.
And this is where you hear that term, the Minskin Ponzi endgame. Can you define that for us?
Sure. So, Hyman Minsky was an economist who studied financial crises. He proposed that financial booms tend to progress through distinct phases. The final, most unstable phase he called the Ponzi stage.
Ponzi, like a Ponzi scheme. Sort of, but applied to the whole market dynamic. In Minsky's Ponzi stage, asset prices and company valuations aren't supported by actual current profits or cash flow anymore. Instead, they're sustained purely by the expectation of massive future revenue growth and by the ability to continuously attract new investment capital based on those optimistic expectations.
So it's belief holding it up, not reality.
Essentially, yes. The whole structure depends on ever-increasing optimism and fresh money coming in. If the expected cash flow fails to materialize, or if that optimism suddenly fades, the structure implodes, because there's no underlying reality to support the prices. And that is the core risk facing any company like OpenAI, committing $1 trillion to future buildouts without the current operational cash flow to actually back it up.
Okay, that sounds incredibly risky, which forces us to ask the obvious question. What's the compelling counterargument? It's potentially 17 times bigger than the dot-com bubble. Why isn't the entire stock market already collapsing under the weight of this potential overcapacity? There must be a bull case. There is definitely a strong bull case. And perhaps the most eloquent version of it comes from Jeff Bezos. He makes this interesting distinction between what he calls a good industrial bubble and a bad financial bubble.
Okay, a good bubble versus a bad bubble. Let's unpack that. What makes a bubble potentially good?
So, Bezos argues that certain types of bubbles, which he calls industrial bubbles, actually leave behind something valuable and permanent, even if many of the companies involved go bankrupt. His prime example is the fiber optic cable deployment frenzy back in the late 90s. Telecom companies, fueled by the dot-com mania and vendor financing, laid down way more fiber optic cable than was needed at the time. Many of those companies went bust.
Right. Global Crossing, WorldCom.
Exactly.
Yeah.
But the fiber optic cable they laid, it's still in the ground today. It forms the backbone of the high-speed internet we all rely on now. So even though the initial companies failed, the bubble left behind tangible, permanent, productive infrastructure. Early biotech booms might be another example. Lots of failures, but they built labs, trained scientists, advanced the basic science.
Okay, so the idea is even if OpenAI itself were to fail spectacularly, the massive compute capacity built by NVIDIA, the huge data centers built by Oracle, maybe even the new power plants built to supply them, that infrastructure would remain. It becomes a permanent, positive societal utility, enabling future growth for whoever eventually figures out how to use it profitably.
That's the core of the good bubble thesis. The goal is to avoid the bad bubble.
And the bad bubble, according to Bezos.
That's more like the 2008 housing crisis. That bubble was fueled primarily by risky financial engineering complex, mortgage-backed securities, credit default swaps, excessive leverage. When it burst, it didn't leave behind much of lasting value. It just left behind a financial mess and foreclosed houses. No permanent, positive industrial infrastructure was created.
Okay, so the bull case for AI today is that this spending, even if excessive right now, is fundamentally building useful industrial capacity.
That's a big part of it. And the other key part of the bull case is how it's being financed. Unlike 2008, which relied heavily on risky debt markets, a significant portion of the current AI spending is being financed internally by the massive profits and free cash flows of the existing tech giants, NVIDIA, Microsoft, Amazon, Google.
Right, they're using their own cash reserves, not just borrowing money they might not be able to pay back.
Exactly. They have these huge, profitable core businesses that are funding this AI arms race that provides a kind of systemic buffer that wasn't present in purely financial bubbles.
Okay, but what's the ultimate payoff they're all aiming for? It has to be bigger than just selling slightly better chatbots or slightly more efficient cloud services, right? To justify $1 trillion.
It has to be much bigger. And that's where this vision of a fundamental transformation of the entire global economy comes in. Broadcom CEO, Hock Tan, provided a really powerful articulation of this. He framed the massive investment scale not just as a tech upgrade, but as enabling a foundational secular shift in global GDP.
A shift in GDP, how so?
Tan projects that generative AI will dramatically increase the portion of global GDP that's related to knowledge-based, technology-intensive industries. These are the sectors most immediately impacted by AI's ability to automate cognitive tasks. He estimates that this sector's share of global GDP will rise from its current level of about 30% up to potentially 40%.
From 1/3 of the global economy to almost half of the global economy being driven by these tech-intensive, knowledge-based industries, that's a colossal restructuring of economic value.
It's absolutely colossal. And if you do the math, that 10 percentage point increase in share translates to an estimated $10 trillion increase in global GDP per year.
$10 trillion a year in new economic value created or redistributed by AI.
That's the magnitude of the prize they're chasing. And if that projection is even remotely accurate, then suddenly the trillion-dollar infrastructure commitment doesn't look like wild speculation anymore. It starts to look like a necessary, almost critical utility investment for society to unlock that $10 trillion potential. The potential economic benefit, in that view, far outweighs the risk of the investment.
So the decision makers, the CEOs signing off on these billion-dollar POs, they're essentially betting that the cost of not building this capacity right now, the cost of falling behind in the AI race, is actually far, far higher than the risk of financial misallocation if they build too much too soon.
That seems to be the calculus. As Mark Zuckerberg put it quite plainly, if you believe you're trying to build the next generation of intelligence, well, you just have to spend the money. There's no cheap way to do it.
Okay, so if we operate under the bull case assumption for a moment, that the demand for AI compute will continue its exponential rise, and that this infrastructure is a necessary utility for that $10 trillion transformation, then we need to conclude with an objective assessment of the investment outlook.
Yeah.
Given this massive CapEx spree, who are the most likely primary beneficiaries?
Well, if you accept that premise, the conclusion almost writes itself. It follows the classic gold rush strategy.
Yeah.
Don't bet on the individual miners finding gold. Invest in the companies selling the picks and shovels.
Right. Focus on the suppliers enabling the whole thing.
Precisely. The clearest primary beneficiaries, almost regardless of which specific AI models or applications ultimately went out, are the chip companies and the core component suppliers. They aren't taking on the incredibly high risk of developing the frontier AI models themselves. They're simply fulfilling massive, often non-cancelable, multi-billion-dollar purchase orders for the hardware needed to run those models.
Okay, so let's run through the big ones we discussed. NVIDIA, NVDA. They seem to be in the absolute strongest position, wouldn't you say? They're like the refinery and pipeline of this whole new industrial era.
Undoubtedly. Their financial performance just shows it. NVIDIA is generating staggering amounts of free cash flow, around $65 billion annually right now, with projections hitting an almost unbelievable $168 billion per year by 2028. Their full-stack advantage, the CUDA software ecosystem, the dominance of architectures like Blackwell, their strong position in high-speed networking, it means they effectively set the industry standard. And pretty much everyone building large-scale AI has to pay the NVIDIA tax one way or another.
Okay. Then we look at AMD. They're positioned as the aggressive challenger, clearly benefiting from OpenAI's and others' need for diversification and a second source.
Right. That huge OpenAI deal specifically gives AMD what they called a major platform to monetize the AI revolution. And maybe more importantly, it validates their GPU technology at the absolute frontier level, proving they can compete. They seem to be succeeding in winning large orders, particularly for inference applications. That's the cost of actually running the trained models day to day, which requires slightly different chip characteristics than training. And they're aggressively targeting leadership performance with their next-gen chips like the MI450. Their stated goal is to capture a significant double-digit market share in the AI accelerator market in the coming years.
And finally, Broadcom, AVGO. They seem uniquely positioned to capitalize on that trend towards custom silicon, the ASICs.
It's exactly. Broadcom benefits significantly here because of their deep expertise in designing and manufacturing these complex custom AI accelerators, and also, crucially, providing the highly specialized high-bandwidth networking silicon that's needed to lash all these tens of thousands of GPUs or ASICs together into one giant coherent supercomputer. Their CEO, Hock Tan, confirmed they're working very closely with about 7 major players on custom silicon projects, and 4 of those have already given them concrete, large-scale production purchase orders. So Broadcom is carving out a really critical niche as the go-to provider for custom AI infrastructure for the biggest foundation model builders.
Okay, so summing it all up, we're clearly in a high-risk, potentially high-reward environment. This trillion-dollar commitment is predicated on a massive financial gamble, financed in often creative, sometimes concerning ways, largely by the suppliers themselves. The ultimate risk seems purely based on velocity, on timing. If the demand for AI compute slows down unexpectedly, if those agentic commerce revenue streams and enterprise productivity gains don't scale up fast enough to meet the colossal cash burn rate.
If that happens, then the market might quickly validate the Minsky and Ponzi endgame thesis we talked about. Those highly leveraged deals, the circular financing structures, they could buckle under the weight of optimistic expectations that simply never materialized into realized revenue fast enough. Right now, the market is pricing the sector largely based on an assumption of continued, almost perpetual hypergrowth. But that core assumption is really the only thing holding this entire trillion-dollar commitment structure together. If that assumption falters, things could unravel very quickly.
So, wrapping this deep dive up, what does it all mean? I mean, the sheer scale of these commitments, it really does suggest we're witnessing something more profound than just another technology boom. It feels like a complete, incredibly rapid re-engineering of global industrial capacity. Everything from silicon foundry output to data center construction methods, and now, critically, all the way down to the fundamental power grids themselves.
What's truly fascinating here, I think, is the fundamental trade-off that OpenAI and its partners are making. They are consciously swapping enormous, frankly unprecedented levels of financial risk, that trillion-dollar commitment in exchange for 2 things: speed and guaranteed access to compute power. They seem to believe fiercely that whoever wins the race to build the next truly frontier AI model first, they will capture the lion's share of the economic value unlocked by that projected $10 trillion annual GDP expansion we discussed. It's a bet the company gamble on speed.
And that race for speed is now slamming headfirst into the constraints of basic physics and, well, civil engineering. The energy requirements for AI are just escalating exponentially. We're talking about needing the equivalent power output of, 20 nuclear power plants just to sustain the current build-out vision?
Which raises a really crucial final question, maybe a provocative thought for you, the listener, to mull over after this discussion. If the energy requirements for AI continue to escalate at anything close to this pace, demanding the construction of multiple new power plants worth of capacity every single year, and if traditional utilities simply can't build generation and transmission infrastructure fast enough to keep up, what does that imply for the future of energy itself? Could we see the kingmakers of this era, the chip manufacturers like NVIDIA, AMD, maybe even Broadcom, Could they be forced to become vertically integrated energy producers themselves? Will they start investing directly in building new nuclear reactors or advanced geothermal plants or massive battery storage projects simply to secure their own critical power supply chain and guarantee that the world can actually plug in all the chips they plan to sell?